You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
Hello, everybody, and welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-exciting Options Insider Radio Network. Lots of great new additions to that network, including Trading Tech Talk. If you're up in arms about all the flash voice hysteria, want to learn more about latency arbitrage, co-location, bandwidth, all that fun stuff, check it out, Trading Tech Talk. I think you're going to like it. And while you're there, maybe you want to learn a little bit more about some option strategies, and we have a new show for you as well. It's called Options Playbook Radio. We take all of these different option strategies you may have heard of tangentially in different areas, and we break them down in some, shall we say, sports metaphors, offensive and defensive plays and that sort of thing. We do it pretty quick too, nice little 15-minute segments. So 15 minutes a week to break down some option strategies for you and some of your questions as well. Check it out, Options Playbook Radio. That's a fun one I think you're going to like. And of course, while you're looking at all those new shows, make sure you download our brand spanking new mobile app where you can listen to all of the programs on the ever-expanding network. You can stream them instantly no matter where you are. As long as you have signal on your device, you can stream that show. You can download it offline for some offline listening down the road on the plane or on a train or wherever you like to listen to these fine programs. And of course, while you're listening, maybe you have a question, maybe you have a comment, just hit that feedback button, hit that email button, and you can shoot your questions off directly to the hosts of your favorite program. Speaking of those hosts, I am not alone on this program, not by a long shot. I am joined by my usual colorful cast of characters, starting off with the man beaming in from the burbs of Chicago. You know him, you love him as the greasy meatball himself, Mr. Mark Sebastian from OptionPit.com by way of Swan Wealth Advisors. Mr. Greasy Meatball, welcome to the Volatility Views program.
Hello. How's everybody doing today?
We are doing very well, given the fact that it's a bit of a sluggish period from a volatility perspective, shall we say. But there's still quite a bit to talk about on the show, listeners. Don't worry. And to help us do just that is none other than Mr. Jared Woodard, formerly of Condor Options and Klineman Financial Group, and now the major domo of research over there at BGC Partners. Jared, welcome back to the show, sir.
Mark, as always, I'm happy to be with you. And Mark, I'm patiently, cautiously willing to be with you as well.
Wow. Well put, sir. And that is your official title, is it not? Major Domo of Research? I don't want to get it wrong.
Minister of Fun. I mean, I go by a lot of names.
I like it. All right. And with the gang all assembled, it's time to dive right into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the program where we break down the week that was from a volatility perspective. We have a little bit of a longer perspective on this episode because, of course, we were off last week for the Memorial Day holiday here in the States. That translated into a shortened holiday week for us this week here, so only 4 days really to look back on. And over the course of that 4 days, not a heck of a lot of movement from a broad volatility perspective. Starting off, as we are typically want to do in VIX cash land, kind of hovered around the 11.5 level for the better part of this week. In fact, as we are recording this today, listeners, on Friday, May 30th, VIX cash is hovering essentially unched at 11.56 right now. So not a heck of a lot of movement from a VIX cash perspective. The futures weren't exactly swinging too wildly either. In fact, as we're recording today, most of them were essentially unched or up a little bit, about a nickel or so on the day from June all the way out to Jan of next year. So not a heck of a lot of movement, but still some interesting developments in between that we can get into in a little bit. But before we do that, Jared, let's start with you. Let's look back on the week that was. And if you want to go even a little bit farther back because we missed the week before, we want to give our listeners their 2 weeks worth of value, then we can look back at the week before too. And what caught your eye amongst that 2 week period from a VIX perspective?
Yeah, I mean, I have to say, one of the big themes of the last 2 weeks has been not just the move lower in implied volatility and realized volatility around the world, but also, I mean, the amount of coverage of that fact. I was thinking back in the last few years, and I'm trying to think of a time, I can't think of a time, when I saw this much coverage, not just in media that looks at options and volatility, but in the broad financial media, this much coverage of low volatility. I think it's been just an explosion of people talking about these facts. And obviously, VIX moving to below 12 is probably a major catalyst. But, people are also pointing out that you've got fixed income, currencies, commodities, all trading quietly, and option implied vol moving lower as they do that. And so it sparked, I think, a lot of really big discussions around trading desks about the causes of this and sort of what it all means and what we can expect for the future.
Yeah, you're right. We may be in a volatility malaise or a volatility doldrum, but there certainly is a bull market in analyzing that doldrum and analyzing that volatility. We like to think we have a little bit of pride of place here on Volatility Views. We've been doing it for quite a while. But there certainly are a lot of people jumping into the volatility space these days because you're right, it is a sexy title, VIX cash, the fear gauge, whatever they want to call it, dropping below the 12 handle, trying to attribute some sort of significance to that 12 level. And then, of course, a lot of them beating that drum for what we talked about in our last episode. When is it going to mean revert? When is it going to gap back up to that long-term quote-unquote average of 20? That seems to be where a lot of the analysis seems to lie. Mr. Sebastian, same question for you looking back on this truncated holiday week as well as the week before, if you want to go back that far. What really caught your eye from a pure VIX perspective?
Yeah, it's funny, the way things, I mean, the VIX is held below 12 the entire week. That's pretty impressive. So we're going to be going on 5 days straight of vol right around 11.5. We haven't seen, we've seen the VIX this low in the past couple of years, but we haven't seen it this consistently low. All the other times, even last year where it kind of got to that 11 level, it would maybe be able to hold it for a day or two, not a week. So, what do I see when I see this? I mean, I don't see a good reason for VIX to rally, except for the fact that the only thing that really is interesting is where the Russell is trading. The Russell VIX, the RVX, is still above 18. So we've got a 6.6 spread between VIX cash and Russell 2000 cash. Russell 2000 VIX cash, and that's just an incredible spread. With the Russell at 1811, we should normally see the VIX somewhere between 15 and 17, not 11.5. So there's some sort of disconnect, and I don't know what's going to mean revert. Is the Russell going to drop lower, or is the VIX going to rally a little bit? But something's got to give on that spread sometime soon. That's really what I think is the astounding thing that we've seen out of the last couple of weeks is that the way that spread has just gotten continuously wider.
Yeah, it's funny. We've been talking about that for a while now, that spread, and you're right. It hasn't really diminished. You'd think all the attention and effort, I mean, RVX even getting a lot of volume as a result, I think, of that, people looking to play that spread, and yet it hasn't tightened. You're right. It still is demonstrably wide and perhaps even wider than it was, which is odd.
You know, I was talking to Russell Rose, and the Russell 2000 so far this year is averaging a full point higher than it did last year, with the VIX at this point averaging much lower than it did last year. That's astounding. And if you look at what happened in kind of an 07 scenario, we saw something similar with kind of NASDAQ vol and VIX vol at this separating. So, you know, do I think that this points toward the market having some sort of imminent decline and reversion? No. But is maybe this spreading out a sign that we're starting to kind of run out of gas on this extended bull run? I think an argument could be made for that. I don't know. What do you think, Jared?
Yeah, I was just looking at the performance of the big indexes over the last several weeks, and we were talking earlier this year about that big divergence that opened up between the NASDAQ 100 and the S&P when a lot of fund managers were selling some of their positions in tech stocks. And since that period, the NASDAQ has pushed higher and has been kind of tracking the S&P higher. So those are both trading really well. But the Russell 2000 hasn't caught up yet. You know, it's been kind of flat to down. And I think that until you start to see those small caps perform well, I could see a bid persisting for the Russell implied vol. So I think in my mind, it really definitely goes more to the question of what's driving underperformance in the equity index, and then all the volatility divergences kind of follow from that. But I'm in the camp that it's more likely that this gap is going to close one way or another, then it's going to just kind of persist forever. So we kind of talked about a trade in that vein this week, and I've been thinking a lot about this question of low volatility and about what would be a catalyst for an increase in realized vol. And I have to say that it for all the talk about mean reversion higher in volatility, I think the missing piece for a lot of commentators has been what's the catalyst? What's the specific scenario? Because if you can't point to some specific cause, something that's going to really make people move out of their positions, I agree with you, Mark. The default has to be that this could persist for a while, this low volatility environment.
Yeah, I mean, I don't see a catalyst, but it's just amazing the way the Russell 2000 was such a leader and now has been such a laggard relative to the S&P. The S&P is kicking the crud out of the Dow, out of the NASDAQ, out of the Russell. I mean, that's what everybody's going after right now. Here we are again today. The Dow's down, the NASDAQ's down, the Russell's down, in relative terms, big, and the S&Ps are up.
Jared, going back to your earlier point about so many outlets that don't traditionally discuss options or volatility suddenly getting into the fray. A very venerable outlet, The Economist, not exactly known as a bastion for derivatives-related analysis, dove into that fray last week as well. Going into the holiday weekend, they had a big piece called The Volatility Crash. And the second I read it, Jared, I instantly thought of you because you're one of the only people I could think of who thinks of volatility in these types of macroeconomic terms. But as The Economist is wont to do, they looked at volatility and attributed it back to some of what we're seeing to what's going on in the broad economy. It was kind of odd just seeing terms like realized volatility in The Economist and things like that. They were talking about how the realized vol out there in the S&P has come in at about a 9 over the past 10 days. That was leading into this article. So in mid-May, they tend to attribute all of that back to saying that we're back in this phase of the great moderation in the economy. We've seen this kind of torpor set in across currencies, across fixed income, GDP, and the broad economy as well. And all of that is starting to trickle back in to the marketplace itself. Hence, we have this period of, I guess you can call it volatility malaise, for lack of a better word. I'm curious, did you see this article? Because it seems like it's right up your alley.
I did see that. I saw that there was a nice editorial, nicely written anyway, in the FT. I think it was Jillian Tett who wrote that, and then a few other pieces.
The Journal did one.
Yeah. So you had a lot of broad coverage. I think that the one thing that stood out in my mind and actually caused me to do
I'm always a fan of covering broads. That's just me.
Nice. Okay.
Lowering the bar on the show yet again, Mr. Sebastian. Well done, sir. He has that nickname for a reason, Jared.
Someone's got to do that. It's Mark lowering the bar, Sebastian. One of my nicknames in college.
Anyway, I wanted to try to bring some more depth to this angle. So I looked at implied vol skew to see if there really was as much complacency as people were claiming. And what I found was that in fact, for this level of realized volatility, we had never seen delta adjusted kind of normalized implied vol skew in the S&P 500 at any time. We actually made a new data point higher last week, and since then the normalized skew has continued to be high, which is exactly the opposite of what we'd expect to see if there was a lot of investor complacency. And I think that's a pretty decent argument that, at least in the options markets, you don't have anything approaching complacency among investors and hedgers. But even more broadly than that, even less, kind of less finely tuned, the question of what's going to drive volatility in the future, and in that vein, without a specific scenario, without especially some kind of a time frame, a lot of these commentators are focusing entirely on the tail risk and not on the cost of carry. And I think that's why all these low volatility warnings can actually be a little bit of a danger, because, as we know, if you're buying puts kind of month in and month out, because you think that volatility is low and it's got to revert higher, when you're still paying that time decay, that can get really expensive. And while a lot of journalists and broad editorial commentators can be very well aware of volatility shocks and those big tail risks, I think a lot of them aren't paying enough attention to the ongoing cost.
Yeah, it's interesting, Jared, you mentioned that the skew levels in the S&P, because directly contradicting that point a lot of people are making, that including The Economist, they finished up that article essentially saying this set of calm throughout the marketplace has engendered excessive investor certainty, overconfidence in the stability of the system, and a willingness to pile on a lot more risk in pursuit of better returns. Your skew numbers seem to directly contradict that, which is interesting. Their point about piling on more risk may actually be driven by some of this latter data here, including what we're seeing out there in the VIX options. We've talked about that a lot on recent shows. We talked about it with Euan Sinclair on the show. In fact, we have a listener question about that a little bit later. But we've talked how that number is getting strong from a call put perspective. VIX, always a call heavy name, a call heavy underlying to begin with. That's just the way VIX trades. But these days, it's been pushing into record territory and keeping those levels for sustained periods of time. Usually, VIX probably hovers in the 2.5 to 2.8 range. These days, it's well over 3. In fact, as we're writing this today, 3.3. Our friends at Bloomberg also jumping into the VIX call-heavy bandwagon. When they looked at the data earlier this week, it was actually 3.4 to 1. That, at the time, was the highest it had been since 2008. They, of course, compiled that with the fact that the VIX's cash, at least, had closed below 15 for the last 27 days, which, when they look at some of the analysis they've done, says the VIX usually rises after reaching these low levels. Again, beating that drum for the VIX has to gap up. The VIX has to mean revert. But again, there's just a lot of interest in these calls. There are about 5.5 million calls outstanding on the VIX these days, compared to only 1.7 million puts. This is from last week going into the holiday weekend, so those numbers may have adjusted a little bit, but still, even though we keep talking about it and we seem to have somewhat dismissed it on the show in the past, it's just growing. The interest and the top heaviness of the VIX from an options perspective is just growing. I think that's partly what The Economist is attributing to as this willingness to pile on a lot more risk in pursuit of better returns. People gobbling up some ridiculous upside in VIX. I know we talked about this before, Jared and Mark, but are you guys perhaps getting a little bit more persuaded by this VIX call heaviness, or you still tend to dismiss this as an indicator? Maybe Mark, we'll start with you.
Yeah, we're basically, if there's lots of call action in the VIX, that's probably part of what's driving S&P skew. Because if you look at kind of how the VIX trades, if you invert where, a VIX call is, while not exactly the same, it has similar characteristics in what it's trying to do for risk mitigation purposes as an S&P put. And what that points to me is maybe we get a little rally in VIX, who knows? But what it points to me is that the market is not complacent and that there is room for the market to still rally. I'm not convinced that is a huge driver of an imminent pop in the volatility index.
Yeah, I mean, we saw some big call buying in August and September in recent weeks, and it definitely supports Mark's point. The interest is still been, I think, heavily to the long side, buying those calls, and I would say too that in terms of where that skew goes and what it means for returns, it's hard to find a relationship, at least among VIX options, any kind of predictive relationship, because historically, if you regress S&P forward returns on the level of VIX call and put ratios, then I haven't been able to find a strong relationship there. And secondly, the makeup of that market is always changing. If you look at data from 3 years ago, the people who were participating in that market, well, fewer of them certainly, but they were also a different kind of trader than a lot of the people who are trading VIX options today. Not necessarily good or bad. It's just that when the makeup of a market changes so quickly and so dramatically, it makes that historical data a little bit harder to wrangle. So
I think that's an excellent point, Jared. 3 years ago, when volume was much lighter, it was in many ways like only the kind of the in the know people. Now that it's become more mainstream, it's a very different clientele.
Yeah. So putting it all together, if anything, it looks like traders are still hedging in a really prudent way, hedging their risk. And last thing I would say is that when the VIX level is this low, that in absolute terms, there's just not the kind of gains from buying VIX puts that you would expect to see if instead the VIX forwards were in the mid-teens or even in the 20s. So I would be shocked, frankly, if there was any heavy action in the VIX puts at these levels, and that means that again that put call ratio, I think in my mind, becomes even less meaningful down here.
Yeah, you're right. There is that systemic issue that there just aren't many strikes really to play with to the downside, not a lot of movement to spec to the CBOE, perhaps hoping to address that by adding the half strikes in a little bit. We'll see how that may impact these numbers going forward, giving people a little bit more strikes to play with on the downside. Maybe that'll change those numbers a little bit, but interesting stuff nonetheless. Before we move on from the broad VIX and the macro economy, there's, like you said, Jared, there's a lot of people pontificating on VIX and volatility these days, and we look at all of it when we're prepping for the show. We tend to toss most of it, and this one we probably would have lumped in that group as well as someone else just pontificating on the VIX, but this was the CEO of Citigroup, Michael Corbat, and he made an interesting point that points back to the macro trends we've been talking about and how they relate back to VIX. He was saying because the earlier part of the year, a lot of money managers have been playing defense essentially, and we've seen that a lot throughout the earlier part of this year. It just translates that they will have to be more aggressive, more risky in the second half of 2014 if they want to have any hope of really meeting their benchmarks for the year and meeting their goals. So we may have this self-fulfilling prophecy rolling into the second half of the year, particularly into Q4, where these guys have to be more aggressive, and that may juice up the vol in the marketplace as a result of that. So that was one of the few viewpoints that I hadn't actually seen reflected. Everyone else is out there beating the drum for the fact that the VIX has to mean revert, but this guy is actually putting a little bit of reason behind why we might see that going forward. Are you a subscriber to that theory, Jared?
I am. I'm pretty sympathetic to that view, both as a matter of what portfolio managers are going to have to do to kind of squeeze some returns out of the market, and also as a potential catalyst, maybe not independent catalyst, but something that would exacerbate any real move if the Fed starts to kind of use their reverse repo facility in a more aggressive way, or if expectations for inflation start to change in a big way. You could see any kind of surprise that just kind of occurs exogenously to the market become magnified in a big way because of the leverage people have been taken out. You're seeing a lot of news stories these days about how, whether it's leverage loans, cov-lite loans, other kind of anything we could broadly categorize under the phrase, a reach for yield, is reaching levels that people associate with 2005 and 2006. And so I think there's quite a lot of managers who are trying to get that yield, trying to find it wherever they can, and maybe taking more risk than they'd love to. And so the people who aren't nimble enough might get caught out in a small move, maybe not a crash, not even a major correction, but something that again could shake some people out of positions. I wouldn't be surprised at all to see that late this summer, maybe this fall. And conversely, in the interim, people have to do something to hit those targets. So I think that's definitely something worth thinking about.
Wrapping up a couple of our favorites here, we've been checking in on VXST options periodically. Those are, of course, the short-term VIX products, and they're still, I wouldn't say struggling, but they're still waiting to really take off. They're doing decent volume, about 500 contracts a day, and their open interest hovering around 1,600 contracts. Both of those haven't really budged over the past couple of weeks, both those numbers staying the same. RVX, like we mentioned in our last episode, also having a bit of a bump these days. I was talking to those guys out there at Russell recently about what they've been seeing going up out there. They saw straddle going up there for some pretty decent size, I believe about 800 contracts out in July, as well as looked like a pretty tight upside call spread, 26-27, one strike call spread up there in Russell going up quite a bit as well, I believe 1,500 times. So there are some players out there. They're also saying they're getting some nibbles on the ETP side for this product. People have seen the success of other VIX ETPs, and they say, hey, we should be really a first mover when it comes to RVX ETPs, so engendering some interest as a result of that. A lot of other products hitting new highs. CBOE has a wealth of products, not all of them vol related, but all of them pretty much hit a new high this week, including VPD, which is their VIX Premium Strategy Index, the VPN, which is the capped VIX Premium Strategy Index, the VXTH, which is the VIX Tail Hedge Index, and then, of course, BXD and BXM. Those are the buy right indexes for the Dow and the S&P. And then there's the BXY, which is the 2% out of the money buy right index. And then their collar index, a less widely followed name, CLL. And low vol, another less followed name. That's the CBOE Low Volatility Index. And of course, PUT, the put right index. That's a name we've discussed extensively on this show in the past. All of those names, all of those products, quote unquote, hitting new highs this week as well. So it's been a good time, even though there hasn't been a lot of volume. There has been some interesting activity in the broad volatility spectrum and in the broad asset class spectrum in general. Speaking of asset classes, let's look at some other vol and some other areas. We've talked in the past about the volatility malaise, for lack of a better word, and how it's extended beyond just the volatility products to areas like FX. And we're still seeing that right now with currencies from a vol perspective kind of just being dead in the water at this point. But we are seeing some interesting specs. Again, this is kind of par for the course, but we're seeing a little bit more momentum behind them, it seems, these days, that we might finally see some juice out there that could excite and engender some volatility in the currencies. In particular, a lot of people looking at the European Central Bank and, of course, China to perhaps juice up some move, new monetary policy, and the influx of some new economic data from these names like China could finally give us some vol in the currency space. Jared, in your new gig over there these days, are you still watching FX as much as you were back at Klineman?
I do. I cover the world as best we can, and so we certainly look at what's going on from a macro point of view. And you mentioned the euro. I think that's a really interesting place to keep an eye on. There's been an incessant decline in implied vol in the euro versus the dollar over the last year. And I don't want to go out too far on a limb, but it's possible we saw a short-term bottom anyway in that premium. At a 1 month horizon, those options were trading at around 6% in mid to late April. And since the central bank has started talking up its policy and a little bit more aggressively, we've seen a little bit of a rally in the premium in the euro, getting almost back to 7% a couple days ago. So I think that's something coming further down the pike. It's probably not the time to be long of vol there in a big way yet, but there's definitely a sense out there that the sentiment is turning.
All right, and speaking of other asset classes that have exhibited some volatility of late, you got to look a little bit further afield to some of the commodities to really find any hint of vol these days. One of the names that I know a lot of our listeners like to pay attention to and have been trading pretty actively, of course, is gold. Gold taking it, shall we say, a bit on the chin in recent weeks. Not a good couple of weeks, not a good few sessions for the gold bugs out there. Talking to a lot of the people we work with in the different brokerage space, they all say a lot of their clientele that are heavy into gold still bidding up that protection, refuse to take their losses, refuse to cut those longs. They're doubling down, they're loading up. So we're starting to see a little bit of that reflected in the gold vol. In particular, earlier this week, we saw a nice little pop in June and July, in particular out in GLD. And a lot of people listening to this show love to play in the ETFs and GLD. They popped a bit up to about 16. They're hovering these days right around the 14 level out there. GVZ also popping earlier this week. That's, of course, the CBOE Gold VIX. That popped to about 16.5 on Monday. Then, like pretty much every other volatility product this week, kind of just trailed off for the rest of this week. As we're recording right now, it's hovering right around 15.30 or so. But, of course, this brings up some questions, too, about what risk premium we're seeing, or perhaps lack thereof, out there in gold land, and if that perhaps translates into some interest, kind of like the discussion for the VIX, if that translates into some interest for moving to the upside. I know, Mark, you guys have a gold course, not related to the gold product, but I'm sure a lot of your clients over there and mentees at Option Pit are interested in some of the volatility in the commodities as well.
I mean, the big thing has just been that gold has been such a succubus in its performance. It's terrible. I mean, it's heading right back to its lows of 2013. It's done nothing.
Did you say a succubus?
It's been a succubus.
As opposed to a succubus?
Correct.
You need to know your monster mythology if you're going to be on the show, sir.
Sorry about that. Anyway, it's been terrible. It just sucks. And what's interesting, though, is there is some volatility there. So, if in the commodity space, gold is one of the, in kind of the equities, GLD is one of the few interesting products to, trade a front spread, or gold and Russell are about all you can do. But I've been watching, and the way gold looks, it just looks like it's going to keep going lower. I don't like it at all, and and the vol is kind of confirming that. So we talked about the way that Russell vol hasn't imploded, and the Russell's been underperforming. Gold vol has not imploded, and the gold is underperforming, and I think that's a trend that you can watch. NASDAQ was underperforming. Its vol was high. The vol implodes. Now NASDAQ is keeping up with the S&P. So it's been pretty clockworky watching how that trade forms.
All right, and that's going to do it for our volatility review for this episode. And now we're going to dive into your portion of the show, because it's time to check in on the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, welcome to the Volatility Voicemail. This is, of course, the portion of the show where you guys get to join us here on the panel. And it's funny, we get a lot of feedback for this segment, but everyone seems terrified of doing the titular voicemail, of actually leaving their voice and having it played on the show. I think that scares a lot of people. So the few brave souls out there who want to call in and leave a voicemail will actually play you on the show. If it's interesting, keep in mind it can't be a Sebastian-esque email, so no swears or bad references or anything like that. But if the few of you out there who are brave enough, check out the Volatility voicemail line, and perhaps we'll play you here on the show. But we do have a lot of feedback, a lot of questions, a lot of comments coming from the listeners, starting off with Jim Charles, writing out of Lexington, Kentucky. I think this is our first questioner from Kentucky here. He writes, I know your recent guest, Euan Sinclair, downplayed the VIX call-put ratio as being due to systemic issues with the product, but that indicator has only risen since that episode, leading me to believe that there is something to it. Where do you guys stand now on VIX call-put? Are we poised for a pop, or is this just a result of the CBOE beating the mean reversion drum back to 20? Well, Jim, we kind of discussed this earlier in the episode, and you're right, listeners, if you missed the earlier episode where we had Euan Sinclair, we discussed this very issue with him then, and he made some interesting points that we just discussed earlier here in the show again today about how the fact that it's just attributable to the fact that the VIX is just so low. There are just fewer strikes to play with from a put perspective. There's also less potential movement to the downside if you're going to spec on a product, are you going to spec on a move from 11 to 9? Or are you going to try to spec on a move from 12 to 20? What's more attractive to you? And I think it's clear looking at the data in the marketplace that the latter is much more attractive to people. I will concede, Jim, that there has been a lot of that drum beating out there. We've discussed it as well. A lot of that coming from the CBOE and other holders of these volatility indices saying, hey, look, guys, something's got to happen. Something's got to happen. The long-term average is 20. Volatility is mean reverting. This thing's going to pop. You better be ready. You better get in there. You better trade. You better trade. So there is certainly that drum beat, and we're seeing it out there in the broad media as well. If you go out there and just search for VIX in Google, count how many articles you see talking about that exact fact. So there is certainly a drum beat for that, which I think is contributing to it. But I think at the end of the day, it probably is just this systemic issue. It will be interesting, like I said earlier, to see if perhaps this half strike addition juices those numbers a little bit, gives a little bit more interest in the puts, gives you essentially double the number of strikes to play with to the downside. The net movement is the same, so if that was your issue, that probably won't attract you. But if there's a paucity of strikes keeping you out of the put side, then maybe that could help a little bit.
You know, the only thing I'll say is everyone uses that 20 as a mean reversion, and
it drives me crazy.
It drives me nuts because I don't really even consider that to be the correct number. There's a lot of different analysis. I mean, Jared, what would you say is the actual, if you had to pick a level where volatility is neither high nor low, all right, in terms of over the next 5 years, whatever, you wouldn't know. It'd be 50-50, higher or lower. What level would you pick, you think?
This point in the economic cycle, I don't know, 15 feels right. I looked at this, I was talking with Henry Schwartz about this recently, and we were talking about how, the distribution of VIX isn't like the distribution of S&P returns.
Mm-hmm.
And so, looking at the mean level in the first place isn't going to be as helpful. I looked at the median VIX since I think, the beginning of the data, and even that was just 18. So,
yeah.
So talking about 20, I think, is probably not the best way to think about expectations.
Yeah, I think 17 or 18. For me, anywhere above 17, I consider the VIX to be elevated. Just generally speaking, 17 and a half, somewhere in that range, regardless of economic cycle. So, when people talk about the long-term mean of the VIX is 20, I think the long-term normal level of VIX, over a 20-year period should be right around 17, 18, somewhere in that range. Because realized long-term actual volatility is, 14, 15%. And the VIX should trade at a 2 to 4% premium. And there you have it.
I think you and I come to it too, Mark, with that old SPX bias that, when it got to 15 out there, that was crazy time. That was high levels of vol. You wanted to sell it. And so I think just it's hard to break from that mindset. 15 seems to be a much more appropriate frame of reference for that sort of thing. And I hate to attribute motive to anyone, but it seems like a lot of the people out there beating the drum for that 20 level are people who have some sort of axe to grind with the product itself, and they want to engender some action, some excitement, because otherwise people might say, hey, VIX is low. Why should we touch this thing? You might see volumes trailing off. If you keep beating that drum for this thing's mean reverting and it's got to gap up to 20, it could almost double. That engenders a little bit more near-term excitement, gives you a lot more activity in the media cycle that you could use to drive volume. All right, moving on to a question from, nice to have the ladies writing in, Annabelle Schmidt. And she writes, you guys profiled a sizable VIX vertical call spread in the September expiration cycle a few episodes ago. Mark mentioned that it might be tied to an OTC variance trade. Is there any way for customers to get more information on that dark portion of the volatility market? It seems like quite a bit of the daily activity actually occurs in the OTC realm, so we're only getting half the picture if we just looked at listed VIX trades. Great show, great discussions. Hopefully Jared will stay on the program now that he has a new job. Well, I think Jared, you'll be on for a little while, so she doesn't have to worry about that, right, Jared?
That's right.
But this is a good point to Annabelle, and I believe, as I recall, the trade you're referring to was a SEP 1926 call spread, went up about I think 130,000, maybe 150,000 times. It was a sizable trade, whatever the actual number was. And you're right, I did speculate on that. A lot of people were writing it up as a straight upside spec, and it could certainly be that. But when you see that kind of size going up in a listed volatility product, it tends to be correlated or associated to something that already went up OTC. And with a spread like that that's so far out of the money, it probably is more likely to be some sort of upside hedge in case the worst comes to pass. You have someone out there who's shorting a ton of VIX and wants this spread up there in case the worst comes to pass. And VIX does gap up in the near term. He's got this spread there to protect him. I tend to lean more along that side of the fence as being a more rational argument for that spread. Granted, the irrational could also happen too. People spec on VIX in crazy ways all the time, but that was where we fell on that. And to the other part of your question, that's something we've discussed quite a bit on this show, and it is difficult, very difficult for you guys, the retail customer. I'm assuming you're retail, Annabelle. I don't mean to put you into buckets if you're not. It's difficult for the retail guys, and quite frankly, for a lot of us here on the show, to really penetrate a lot of what goes up OTC because it is so siloed. It is done on essentially a bespoke basis from bank to bank and firm to firm. There are a few outlets you can go where some of this stuff is shopped. You can see some of it that way, but quite frankly, getting the broad perspective of everything that's going up OTC on a daily basis versus what you see in the listed market, it's a big chore. And it's something we're still working on cracking so that we can do that. So we can say for you on a program like this, hey, this VIX call spread went up and it looks like it went up against this big variance trade that went up over here or something like that. Right now, we're just speculating. We would love to have that data in hand, but it is a difficult thing. Jared, I'm sure you've encountered this doing all the different research and analysis and crunching all the data you did for Klineman and now at your new gig. This probably is a frustrating thing for you as well.
I mean, absolutely. It'd be nice to have all of the variance swap data in one place, and maybe one of the few positive side effects of Dodd-Frank in some long future date would be that swap execution facilities kind of dominate, and we have centrally cleared massive closed markets. But until then, we can still look at swap rates to see what people are doing. I was looking at this yesterday, actually. The interesting thing I saw in, at least for SPX variance swaps, is that compared to this time last year, there's not much difference in the rates around 3 to 12 months out, but there's been a definite flattening of the back end of the curve. So talking about 1.5 years out to 2 years, swap rates implied in the market are about 3 points lower than where they were last May. And I thought that was just an interesting thing to note as expectations have changed.
Great question, Miss Annabelle. Like I said, always great to see the ladies writing in. And yeah, we'll try to stay on top of that stuff for you, but it is a laborious task. I think that's a good point, Jared. The CEFs are out there, the CEFs are looming, and hopefully, if all comes to pass as expected out there, eventually we'll see these things going up on a CEF, which is, of course, a swap execution facility, and then we will have a little bit more insight, a little bit more transparency into what is going up there. So just be patient, I suppose, Annabelle. It might make it a little bit easier for you. All right, last up, we have the age-old question coming in here, this time from Sienna78. He or she writes, S&P 500 at a record high, VIX at a record low, portfolio looking good, a VIX AUG 1216 call spread for $2, or the SPY July 190, 170 put spread for $230. Which is the best protection? I know which way I lean, but I shall let you guys go first. Mark, we'll start with you. What do you have to say here for our friend, Mr. Sienna78?
Well, it really it's not as simple of an answer as which is the better spread. It's kind of what is where do you perceive risk and when do you the more you're going to get a more certain hedge out of the SPY, but potentially the VIX call spread would provide some sort of real protection, but I don't think you get the 1216 for $2 gives you really only has $2 of upside, and the 190 170 for $230 has $17 of upside. So you do the math. I would generally think that if the market's going to drop, the ability to make $17 on $2 versus $2 on $2, I know which one. I generally lean for something that has a higher return, higher ability to provide returns, if you will.
Well, I like Mark's analysis there. That sounds good to me. The only thing I would add is that One of the perpetual advantages of these vol products is that they're not tied to particular strikes. So if you're looking to hedge something, August might be a little bit too soon, but if you were looking at a longer dated hedge, and you were worried that the market might keep rallying and the S&Ps might be 100 points higher, obviously your S&P positions, put spreads would be toast at that point. But a VIX trade, VIX position might still have some life in it. So that kind of independence from S&P price strikes is a nice feature, especially when implied vols are already relatively low. So that's something to keep in mind as an alternative.
Doing a little devil's advocacy there, Mr. Jared, arguing for the VIX. Well, I guess I'll be the tiebreaker then. I'd be hard-pressed to find any scenario where I pick, particularly because he or she said they want it for a protection, aka a hedge. I'd be hard-pressed to think of a scenario where I would pick a VIX spread over a direct type hedge like a SPY put spread. I'm assuming he has a broad portfolio linked to the S&P. If he wants a hedge, the S&P is going to be that. Whereas the VIX, if he was talking spec, that's a different story. But the VIX is not a hedge. I've said that many times on this show, and I'll say it again. The VIX is a good kicker to a hedge position you may have on already if you want to put on a put spread and then do the VIX call spread as a little bit extra bang for your buck in case the VIX explodes. That's fine. But if you're relying on VIX as a hedge, we've talked many times on the show how it doesn't move one-to-one with the S&P. It's not inversely correlated. So definitely, if you're looking for a hedge, I would certainly go for this SPY put spread, in addition to all the things Jared and Mark just said about the profitability of a $2 spread with the potential to make $2 versus $17. There certainly is some logic to that as well. All right, great questions from everybody there. Again, if you're feeling courageous, try out the voicemail line, see if we feature your question on an upcoming episode. Meanwhile, we have to roll on into our final segment, the Crystal Ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, you guys know what time it is. It's time for us to prognosticate wildly and indeed recklessly on what the vol gods may hold in store for us here. We'll start as we are wont to do in VIX land, then you guys can run as far afield as you like, whatever products are catching your eye. Mark, since you don't make it on as often, we'll start with you.
I think the VIX might break, I'm going to go out on a limb and say the VIX will settle above 12 next week.
Crazy talk, sir.
I know. Call me Captain Daring. And in terms of that, I think you continue to see the Russell underperform. I think you might, and honestly, I think that, the market's looking a little tired. I think vol's looking a little tired. We might get one of those little interim pullbacks. Nothing serious. Testing, I'll call it 1870, 1880 sometime, over the next week. Maybe we give away 35 points in 2 days or in 2 or 3 days, something like that. With like it's you get the one day where we're down 1%, the one day where we're down 0.75%, the one day we're down $5, and then we rally off of that. I think we're setting up for one of those.
Mr. Jared, take us home. What are you watching? What are you expecting from vol for the coming week?
More of the same. Short gamma is the way to go until it isn't. And, I kind of think that we'll see something this summer in terms of whether it's rates or credit that'll get people shaken out a little bit, but I don't think we're going to see that yet. Going further afield, a lot of the equity indexes in East Asia have rallied, and implied vol has come down there even more quickly than it has in the U.S. markets. So if you look in terms of Z-scores, like standard deviation under the difference from the mean, in some of those East Asian and South Korea, Japan, even China, the move there has been so fast and so furious, lower in implied vol, that if you want to trade mean reversion, put on a long vol position, I think those might be actually a little bit more attractive. And that's something we talked about to clients this week without having to put on a big whole economic thesis, more as a short-term relative value trade.
All right, and that's going to do it for our Crystal Ball segment. That's also going to do it for this episode of Volatility Views. But before we go, as always, let me check in with each of my cohorts here, my partners in crime on the Vol Views panel, to see what they have coming down the pike that may interest you, the listener, until the next time we can all gather together here on the old program. Mark, perhaps we'll start with you. What's coming down the pike over there at optionpit.com, as well as Swan Wealth Advisors.
At Option Pit, we're launching this all-day chat. We're offering it at 99% off, $2.40. So for the first month. So give it a look-see. I think it's worth it, and we've been doing a pretty good job there. And then at Swan, the defined risk strategy moves on, and we're still working on Swan Re, and it's just been, we're kind of dabbling into, we're starting to look at maybe adding some new products, but I can't really talk about those yet. So there's just all kinds of exciting stuff that we're doing over there, though.
And Jared, what's coming on the pike over there at BGC Partners?
So we put out a note last week about that tech sell-off in the first quarter and what SEC data showed that fund managers had been doing. Some really interesting changes happened there. And then, as I mentioned, kind of fighting the good fight against the VIX complacency thesis this week. I'm working on a new project looking at the performance of collar strategies historically and how data from implied volatility skew can influence and assist the performance of collar strategies. And that'll probably be done in the next week or two. So a lot of exciting research and analysis work in the near term.
You have to make sure to share some of those results with us when you get that collar study done. There has been a lot of interesting stuff done with the OIC and the collar spectrum, and they have added an active management component where they adjust the duration and different style of the way they implement the collars. But to my knowledge, there's never been anything done taking that research and then applying the skew like you're doing there. So that would be very interesting stuff, and certainly stuff we'll like to discuss here on the program when it's all said and done. All right, and on behalf of Jared and Mark, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing, and of course for writing in with such great questions. And if you're feeling up to it, give a try to the old voicemail line. Don't worry, we won't make fun of you. I can't speak for Mark anyway, but I won't, and Jared probably won't. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.